Also joining us right now to break all this down is David Albrycht. He is from Newfleet Asset Management. Also, David Lebovitz is here from JP Morgan Asset Management. We had a call, I think, at about, well, I don't know who was on in the 5 o'clock hour this morning saying 7 to 10% pullback. The market, by the way, this morning doesn't, in the U.S. at least, does not seem to be saying that. What do you think?
So I think, from a bond manager's perspective, that valuations are getting a little cheaper. We've had a flight to quality. We've seen the 10-year Treasury go from about a 190 to a 151, now backed off to a 154. For us, it's allowed us to fill out positions that were expensive just 4 weeks ago. QVC, Stations Casino. We added Ladder Financial and also Neighbors Energy. But positions that just 4 weeks ago looked expensive. Now they've cheapened up a little. Becky had mentioned Macau. Gaming is something that we like to invest in. We like the consumer. The single biggest gaming space is Macau. So we have a small exposure to MGM. We're looking at things like Galaxy, Las Vegas Sands, and then Wynn that has a 72% exposure there. So there's opportunity.
There's opportunity. What are you doing?
I think the big question is how long does this last? And does it evolve from a demand issue into a broader supply chain issue? I mean, if you think that this is going to be transitory and we're going to start to come out of the woods sometime in March, do we see 7 to 10%? Maybe not. Do you want to be a little bit more defensive in the interim? Absolutely. But I think the big question that investors are grappling with today is how long does this go and what is the broader impact on the global economy? And the PMIs this morning basically mean nothing, right? Because the surveys were done before all of this began to gather steam. What's been giving me a little bit more pause recently is this divergence between the survey data and the hard data. People are looking for that hard data to catch up, and if this gets in the way of that, I think it further impedes the equity markets marching higher.
To that question, Mike, about how long it goes on for, did you look back at SARS? Have you looked back at these other things? Does it give us any clue as to what might happen?
The key is that everybody has looked back at SARS, and everybody has kind of built the model for saying, here's what we'll know, because here's what we knew in SARS, when you basically saw a little bit of an inflection, the slowdown of the rates of infection, all the rest of it. And by the way, last week, we did see this late-day rally when the WHO said, this is a national emergency, but we're not telling you not to travel. I think that was the machines basically saying, aha, the SARS game plan is underway.
But
the problem is the situation. I don't even mean the disease. I mean the market position. We were like 2 years into a bear market back then. It was just another thing piled on to the other set of concerns. You were waiting for the invasion of Iraq in 2003. I mean, it just doesn't seem like it's a clean comparison to where we were now, which was a market at all-time highs, 2-year highs in valuation and sentiment. We needed something just to sort of take the froth out of the market. This came along to do it.
Meaning that it's such a different market position because there's such a long way further to fall, or because you still have optimism that will keep things afloat because you haven't had all these.
I think you have. I think it was you were ready for some kind of a correction no matter what, almost. And the argument is that if this is not an economic event, and if in a long-lasting way, then I think the market is probably in decent shape. But I don't think anything gets us out of this late cycle psychology, right? Even though it's not really necessarily over, I think that it's very easy for the markets, as you saw just there, to flip back into, yield curve is flat. It must mean something bad's happening.
And you saw that rise becoming somewhat untenable, right? You had moderate growth, you had an easy Fed, you had trade, which was finally coming off the boil. And I mean, for a long time, we've been talking about how it's difficult for those three things to coexist. Arguably, I think the most important thing for investors to look at right now is what's going on with earnings, and more importantly, what does guidance look like for 2020?
But that's the problem. The guidance on so many of these companies is we don't know because this creates a huge amount of uncertainty.
And I think the big issue from where we sit is you have consensus still penciling in this 10% number. Our models are saying something more like 4 to 5. The cushion that we have if this does evolve into a broader issue just isn't what it was earlier in the cycle. So to your point, you still see rich valuations, you see earnings growth slowing, and you have this kind of broader unknown at a social and global level. I think that we're at a minimum in for some volatility here over the next couple of weeks.
All the stocks that you mentioned, you're buying them, and are you calculating, okay, these could go down another X percent, but still we like the valuations here? I mean, tell me about the framework for thinking about an individual stock buy.
It was the bonds. It was the bond market.
Oh, you were so I was going to ask you that. All those names that you mentioned, you're buying the bonds or you're buying the stocks?
So we're buying the bonds. I'm a bond guy.
Okay.
I'm a relative value guy. To what everybody said, is it transitory? Is this going to be a black swan event? We've already de-risked our portfolio last year. The bifurcation we saw in high yield in the bank loan market was up in quality. Quality has continued to outperform. We saw it in emerging markets. Last year, quality outperformed high yield by about almost 9%. We've seen that trend continue. So, we still like some of the emerging names, longer duration. So we're getting the benefit of the yield curve flattening. Chile, Russia, Indonesia, Mexico, Brazil is a double B for that matter. Then some of the revenue-generating corporates in Mexico make sense. A Televisa, a Pemex, a Cemex, a Coke FEMSA. So, I'm sorry.
And and we would agree. I mean, we see value in some of the emerging markets as well when it comes to fixed income. I think you need to pick and choose your spots because obviously, if this gains momentum, it's going to create a bigger problem in Southeast Asia, at least at first, than it may in Latin America. But kind of latching on to what you were also saying earlier, we're finding a lot of value in things like securitized consumer loans, things of that nature, where you're getting a little bit of yield.
This is arcane for the average viewer.
Well,
I mean, the retail viewer,
Let's just talk about what happens for some of these companies, because with most of the guidance we've gotten to this point is they'll be closing stores through February 9th. Right. But I don't think anybody really thinks that's the end date for any of this. I don't think you're going to have your arms around this in less than a week's time.
No, I don't think anyone has anybody feels like they have it under control in terms of knowing what the ultimate magnitude is. Right. The market is racing to this point where it says, yep, we can write off first quarter growth. We're going to have to push this out. Whatever kind of trade piece dividend we thought we were collecting, it's deferred right now in terms of growth, in terms of trade. But all of a sudden, the talk turns to, wow, but the Chinese are going to come in with massive monetary stimulus. The Fed, we're already pricing in an ease or two. So that, to me, is the playbook that already people are grabbing for, whether it's right or not.
Is the 10-year yield already caught up to this idea that the Fed has to get reinvolved there?
The short end of the Treasury curve, I would say, is pretty close to pricing in more than one ease this year.
I would agree with that. Our range on the 10-year this year was 1.5% to 2%. We started the year at 190. We're down to 154. So, and China's already come in, $174 billion of stimulus today. They've cut their repo rate, so they're doing the right thing on the monetary front. And around the world, central banks are still very accommodative. So it's sort of a wait and see. Do you have plenty of liquidity in your portfolio or able to take advantage of opportunities when they present themselves?
But it's interesting because everything I read over the weekend, right, the sell side narrative hasn't really budged. And it's, the reflation trade isn't over. It's just simply deferred further into 2020. Right. And so I think, how long are investors willing to look through this and say, I really do think that global growth bottomed in 4Q. I do think that it's picking up, over the course of the next couple of months or next couple of quarters. And we're going to see this rebound in profits. We're going to see this rebound in growth. We're going to see this elusive rebound in CapEx, which I think may be more challenging to get to materialize.
By the way, you've already had people getting very hedged, and it was all because of the Democratic primary. So it was almost as if we're gonna hold, but we're gonna hedge. Now the hedge also works if it's because of coronavirus that you're going down, but you also quickly get into election mindset and a wait and see, both for corporates and for investors.